Hello, my name is Connor Bryant, and I'm an advisor with Bryant Asset Management. As you know, achieving your financial goals can be a complex and challenging journey, especially with shifting market conditions. In this video, we're going to discuss portfolio diversification, what it is, how it works, and why it's important. To begin, let's start with an overview of financial asset classes. There are many different types of classes of financial assets, and each one performs differently. Assets like stocks, bonds, and commodities. And within each of these asset classes, there are sub-asset classes. For example, stocks include large cap or large companies like Walmart and Microsoft. While bonds are comprised of long-term government bonds and corporate bonds, and commodities break down into two groups: soft, like corn, wheat, and sugar, or hard, like gold, oil, or aluminum. Each asset and sub-asset has a different level of investment risk, and how you divide your investments among them, or your asset allocation, determines your risk and return potential. In an effort to help protect your portfolio from significant losses, you diversify your holdings, or adjust the percentage of each asset and sub-asset class held. As a result, you may get a degree of portfolio stability to help offset or minimize market fluctuations. For example, between 1973 and 2013, when bond prices fell, stocks and commodities went up in value. And when stocks dropped, bonds and commodities appreciated. And typically, when commodities decline, stocks and bonds perform well. But since no one knows what the future holds, it's important to maintain a portfolio that's broadly diversified. And that's when rebalancing is key. Rebalancing means that some of the assets in the portfolio are periodically sold or new ones are added in order to realign it and maintain the weighting of each asset relative to each other. A diversified portfolio may work well over time, but not all of the time. Because investors aren't always rational with their investment decisions, like chasing a winner long after it's too late, or waiting too long to sell, hoping the investment might bounce back, or doing nothing because of indecision. And that's where a financial advisor can help. They ensure investors avoid falling prey to this emotional roller coaster and encourage portfolio rebalancing on a regular basis. But asset price and portfolio complexity have made the rebalancing process more difficult. So it's important to work with a financial advisor who has the tools to rebalance your portfolio automatically. So to recap, start by creating a portfolio with the right mix of asset classes. Diversify those assets based on your personal goals, tolerance for risk, tax and income circumstances. And finally, work with an investment professional to rebalance on a regular basis. When combined, you may have a much greater likelihood of meeting your goals-based objectives.